right. So, so like I said, welcome. Many of you know me, so I won't spend too much time on the introduction, but we'll be talking about what exit planning is, how it actually works, things along those lines today. So my name is Ethan Stewart. I own Centennial Financial Group. I'm a certified financial planner. I wear two main hats. Certified financial planner is helping individuals with their overall goals, reaching retirement, helping them make the most of their money. And then certified exit planning advisor is where we'll be is the hat that I'll be utilizing today. Certified exit planning advisor helps not only maximize value, but helping business owners and entrepreneurs to get the most value they can out of their business to be able to enjoy the next stage in their lives. So we're going to be talking a lot about that. So today we'll be going over the current need, what the need looks like, why it exists, some of the challenges for business owners and entrepreneurs that they're facing, why exit planning is so important, what is exit planning, redefining exit planning, and then how exit planning actually works. And then finally, some next steps, if I can help anybody directly, what those next steps would be, and how we can be a resource to you. So to start off, so this is a question for the group. I know some of you this may apply to, some may not, but the question is, what do you agree on this statement, which is having a transition strategy is important for both my future and the future of my business? Would you guys agree? Awesome. Yeah, so most people do, and most business owners and entrepreneurs do. So to give you an idea, so this is a survey that's done periodically through the Exit Planning Institute, where I got the certification. And so they surveyed a bunch of different business owners, and they asked that question. 99% of them, or the business owners, the owners that were surveyed, 99 agreed in some form with that statement. So they obviously recognize the importance of a transition plan. However, there was a bit of a contradiction because the rest of the data showed that 79% of owners don't actually have a written transition plan. 49% have no planning, have done no planning at all. And then 94% have no written personal third act plan, or what happens after you sell the business. So the point is that everyone recognizes the importance of it, but nobody does it. So the question is, why does that happen? And that's where exit planning really comes in to help out. So to continue on with some of the need, there's some interesting data points that I wanted to include to kind of highlight how important this is, and how little people actually focus on this. The first piece is 80% to 90% of owners' wealth is actually trapped in their company. So I call this the business owner conundrum. You as an entrepreneur, or as an owner, work so hard to build an asset that's oftentimes very, very valuable asset. Well, spending all that time, putting in all that effort, generally speaking, that all your wealth is now tied up in this asset, oftentimes a very valuable asset. But the question is, how do you actually capitalize off of that? And a lot of owners are in that same position, is most of their wealth is tied up in that kind of in that asset. So exit planning is, how do we capitalize on that and get the maximum value out of it? It's very important. 60% of owners don't actually understand their exit options. A lot of business owners and entrepreneurs just don't really know where to start. 80% have not engaged in a formal transition advisory team. So exit planning can be very complicated. And so it's important to surround yourself with a team to actually help you do that. And about 80% have not actually taken that first step. 75% of owners profoundly regret selling their business after a year after selling it. Now, I thought this one was really interesting, but it highlights the point that there's a difference between intentional and unintentional exit of your business. And oftentimes people are forced to sell, not because they want to, and that can result in regret, disappointment, things along those lines. So it's very important that business owners do it because they want to and prepare things around there, not because they have to. And so I thought that was an interesting one. Then 40% of owners want to sell within the next 5 years. I think COVID definitely exacerbated that. More and more owners are looking at what's the next stage. How do I actually get out of the business? 30% say that they have no transition plan at all. And then finally, 50% of transitions are involuntary, forced exit. This is kind of what I was talking about. So if we can avoid that, that will not only maximize your value, but also make you more excited about that next stage in your life. So with that being said, we talked about the need. Now let's talk about some of the challenges facing business owners. So there's three major challenges that I want to touch on. There's a lot of them, but challenges to keep a exit plan actually happening. So the first one is that owners are oftentimes very unprepared. Either they're just not ready. They're not really sure what that first step is. So the first thing is uncertainty. They're uncertain about what to do next. What is the first step? What are things? How does it actually work? And because of that, there's non-action. There's not steps that are taken to actually move forward on making an exit actually happen. The second thing is income trap. So something we'll talk about, and when you're looking to actually exit or find a succession plan or sell your business, you want to build a business that has value and that is prepared for a transition. And most business owners create income or a business that is an income generator. Now you can do both, and I'll get into that in a second. But the income trap is where is a business owner is so reliant on the business to create the income that they rely on, they're not really sure how to get out of that situation. But it's very possible, and we can talk about that a little more. What next? This is an interesting one, and actually this is largely responsible for why most deals fall through. Is because a business owner has worked their whole lives building a very valuable asset. It's almost your baby. And you've been working your butt off to create this asset. If you've been working in one way for your whole life, it's very difficult to transition to not doing that and doing something else. So it's oftentimes business owners decide not to sell their business because they don't really know what they would do after they sell the business. So it's very important to understand and have a clear picture of what you are going to be doing after you take a step back from your business. Confidentiality. Some business owners don't like sharing some of their stuff about their business, so therefore the business doesn't sell because they don't want to share what's needed. Not urgent. There's not a lot of urgency. I think again, COVID helped this, but sometimes they just don't want to, which is fine as well. But having a plan around it will help to maximize the value, which again we'll talk about in a moment. And then misinformed. There's a lot of bad information about, planning versus executing is different. You can plan without actually selling your business. You can have everything ready and intentionally prepare for the eventual time you actually sell. You don't actually just have to sell immediately. And so there's misinformation about how it's done that can cause business owners not to do action. And action is the most important thing in this situation. So the challenge number 2 is the involuntary exit, the threat of an involuntary exit. So what I mean by an involuntary exit is a sale of a business because you have to, you have no choice. And we call this the 5 Ds of an involuntary exit. But these situations are all things that could threaten to force a sale of a business when you don't necessarily want to. And that's death, disability, divorce, distress, and disagreement. So there's ways to protect against these things. And so it's very important when you're building value in your business, preparing for a sale, the first thing and the easiest thing to do is to start protecting these, which add value on their own as well. Challenge number 3 is not focusing on value. So I spoke about that before, but there's a difference between building a business with the anticipation of selling versus building a business to create consistent cash flow, right? So what I mean by that is if you're actually going to sell your business, a potential acquirer would want a business, a machine that works itself and does everything it needs to do, versus if you're just building a business that generates the income that you need to sustain your lifestyle, you're still the business is still dependent on you itself. So by focusing on building an asset that can be sold is different than building an asset that produces income. Now, again, you can do both, but the shift that needs to be made for a business owner in anticipation of an exit is I'm trying to build this enterprise value, which is the value of what somebody would be willing to pay for the business in a future time. So the solution to all these challenges and the need is exit planning. So start off with that. What is exit planning? So I've been throwing that terminology a lot, and it's pretty straightforward, but it's the idea that it's answering the question, it's giving the answer to how do you keep the business, personal, and financial priorities all balanced? How do you maximize those? How do you get the maximum value from your business so that your business, personal, and financial are taken care of? In the methodology we use, we call that the three legs of the stool. All of these have to be balanced and in good shape. Otherwise, any sort of transition is more likely to fall through. And so exit planning is the process of actually preparing and anticipating the eventual sale of a business and keeping all these things balanced in order to do so. And exit planning can create a bit of a paradigm shift. So we'll talk about that next on exactly what those look like, because it's important to make these shifts as a business owner as you're getting through exit planning, going through exit planning. So first off, exit planning exit strategy is good business strategy. So planning for an eventual sale adds value, believe it or not, to your business in general. If you have everything set up in a way that eventually the business will be sold, that adds a lot of value inherently, because a buyer coming to look at your business would say, okay, this person is prepared, ready, have protection, have things in place, and that adds value to the overall machine they're looking to purchase. Exit planning is present tense, it's not past, it's not future, it's a combination of those, but exit planning is meant to be present because you're consistently working on it. It's an ongoing process to improve on that. So these are something that we'll talk about more, but there's a methodology, the methodology to actually build value that we use. There's 5 stages of maturity to get to a business to the point where it's ready for the sale. That's first is to identify improvement opportunities, protect against the unknowns or the 5 Ds that I mentioned that are, that could cause an involuntary exit, to build and to cover those improvement opportunities, to build the value of the business, to then harvest the value, and finally to manage the enterprise value until you're ready to actually sell. So this is the process to actually get your business to the point of exit planning, and it's important to recognize that that's an ongoing process and present. You can decide to start building value in your business today as opposed to the future or the past. You want to make that decision now and recognize that it's ongoing. And this process helps to simplify everything. Exit planning can be very complicated in its nature, but at its core, it's relatively simple. You're trying to get the most out of your value and find a buyer. But how that happens is a lot easier said than done. So it's important to have a clear roadmap and plan to get you to that point as well. And finally, integrate the 3 legs of the stool. And that's what I mentioned before. Keep the financial, keep the business, and keep the personal all balanced, so that when you get to the point of exiting your business, there won't be any hiccups or issues or cold feet that causes it to fall through. So it's important to keep everything in balance. The second paradigm shift that I want to talk about is optimizing value. Value becomes all about transferability. And what I mean by this is that, if I say my business is worth, millions of dollars, but nobody wants to actually buy that, is it actually worth what I think it is, right? So when you build value, you're really building it to be more attractive to somebody to purchase it for you. And that's the paradigm shift that needs to happen. Is it's all about transferring it and making sure the person purchasing it's as value as possible to be to somebody actually looking to purchase. That's why it's so important to focus on value. I'm I'm not building a machine that creates income. I'm creating a machine that will then be able to transfer somewhere else. If I am building a business that completely relies on me and I leave and the machine falls apart, well, I'm not really building something that can be transferred. I need to build something that can run with or without me, and then by the time I sell, I can easily move it and transfer it over to whoever wants to purchase it. So, and the last bullet point that I want to clarify is that building that value and building that machine, you can create value and income. It's very possible, but by doing that, you need to create value first, which will then cause the income to be created from that machine. So it's just this shift that should be made as a business owner to focus more on how do I make this more valuable to a potential buyer. And then the third shift is adopt a common framework. So the methodology we use is a value acceleration methodology, and that is a methodology to be used that we'll talk about here in a minute that helps maximize the value of your business while aligning business, personal, as well as your financial goals so that everything moves forward smoothly and that you get the value that you need as well as what you want. And the buyer is happy as well to be able to cause the transition to move forward and to settle. So the methodology takes time, and we'll talk about that more here in a second. But it's very important to have something that is repeatable and reliable so that this very complicated situation can become more realistic, and we can focus on action to actually make it realistic, to make happen. So I won't go too much into this because there's a lot here, but this is the methodology that I use, and that is used through the exit planning approach. And so the idea here is that the three main stages. The first is the discover stage. It's really important to understand a bit about your business. So the first step is to do analysis into the current valuation. What does your finances look like? What is your the three stools? How do they stand? The readiness of your business, the readiness of you, things along those lines, and really kind of discover again the improvement opportunities, and then create an action plan from there. Then the second stage is the prepare stage. This is the one that can take the longest, but also arguably one of the more important ones, is actually preparing your business in terms of, or to prepare your business for an eventual sale. So this can take time, but really what you're doing here is executing on that action plan you define in the discover stage, figuring out where the improvement opportunities, going through and building and creating and executing on how you solve those improvement opportunities. And we do this through a 90-day, what's called 90-day sprints, or about quarterly time frames that are short enough to adjust, but long enough to actually make sure that we execute what needs to be and add the proper value on the business where it needs to be added. And so after you do the prepare and actually start building the value, then we get to the third stage, which is where we'll spend most of our time on today, which is arguably the most important, which is the decide stage. And this is where you actually decide and answer two simple questions. Are you going to sell, or are you going to keep it and try to build value again? Because again, and we'll get to this in a second, but you want to make sure when you sell your business, you not only get the most out of it you can, but more importantly, you get what you need to be able to create the lifestyle afterwards that you want. So if you can't, when you go to sell, you decide to go back to, let's build the business, let's build the value a little more, and then look at it again. So the last two stages, the prepare and decide, can kind of be a cycle. When you get to the decide stage and say, okay, no, I don't want to sell yet, I want to build value, you can go back to prepare and just keep repeating that until you get the value that you actually want. So that's a high level what the methodology looks like. But today we're going to spend most of our time on the third gate, or the third stage, the decide stage. So the first thing to look at is, again, you're asking two main questions: are you keeping or are you selling? And this should be assessed every 90 days. When you're actually moving forward in the exit planning process, you should be asking that question every 90 days, because within those timeframes, you'll be able to rework and make some improvement opportunity. But frankly, there may be a time when you're just getting tired of working in the grind, working in the business, and you want to actually exit, in which case it might make sense to sell more so than at a later time. So it's very important to ask this question on an ongoing basis because it may change for various reasons. There's other reasons to look at it. Maybe the market changes in that time frame. Maybe it gets better to sell. Maybe it gets worse. So there's more of a reason to do that. Maybe there's additional value. Enough value is built after going through and improving things. But really, that's why it's so important for the business owner to ask this question. Is really, this is the essence of exit planning, is actually getting to that point of taking the leap and selling or not. And so it's important to make sure that you get what you need. And then it's important, once you actually do decide, to understand what kind of options there are to actually facilitate the transition and actually execute. And there's several here that we won't go much into them, but we'll talk high level. But in the end, you need to make that decision before anything else is considered. Continuing on here, risk versus reward. So just to be clear, this value acceleration methodology takes time. This whole thing will take time. Typically, I say it's 2 to 5 years. So anybody, if you or anybody, or anybody that's owns a business that's looking to retire in 2 to 5 years, is typically what I say. That's where exit planning should be considered. It's never too early to look at exit planning, but to really hone in and come up with a strategy and start building value to where you need it to be, that 2 to 5 years is usually the sweet spot, because it gives enough time to adjust if necessary. And just to be clear, it will take investment into the business. You're going to be doing a lot of changes. And really trying to get the business to where it should be to actually sell. But the rewards are great for doing that. And yes, it'll add complexity. And this bullet point here says 12 times increase in complexity. But by doing all these things and investing all this stuff and intentionally trying to grow that value, you can add 2 to 3 times more than you would have originally if you do it as intentionally as you should. So you definitely see the value from it, but make no mistake, it takes time and it takes a lot of effort to actually make it happen. As anybody growing a business knows, the action is what matters, and it's easier said than done oftentimes. And so when you actually get to the point of transitioning, there's several different options on how that's actually happened, or how it actually happened. So you want to look at your options, figure out the best options. And this is kind of part of my role as a certified exit planner, as well as your transition team. You'll want to assess and figure out what is the best option for you, because there are several. We won't touch on them today because there's a lot. I'll be doing a future webinar about that, but I wanted to mention it today. So let's talk about now the what I call the 5, 4, 3, 2, 1 concepts. So these are kind of the concepts around exit planning that should be taken into account, and really talking about the essence of exit planning in general. And that's to start off, the five stages of value maturity. So this is the stages to get your business to an actual mature, ready for exit business. So the first is identify. Again, it's identifying the improvement opportunities of your business, and figuring out what are the things that I need to improve on to build the value of the business itself. The second step is protect. So this is the second step, because there's a very low-hanging fruit to add value to the business itself, but it's protecting against those 5 Ds, right? The different situations in life that could force an exit, as opposed to you doing an exit because you want to. And we're doing this as the second stage because, again, it's low-hanging fruit to add value, and it's easy to get done. And the worst thing in the world that could screw up, or the biggest thing that could screw up an exit transition plan, is some of those things. So it's important to protect first in building the value. Then the third step is building. It's actually building the value, plugging up those improvement opportunities, and just really starting to add value to the business itself in anticipation for harvesting that value you've built, starting the exit planning process, and finally managing the enterprise value when you actually look to exit. So this is kind of the high level process of getting to the maximum and the mature value of a business. And this can take a while. It can be, a business may be, up there near the top of harvesting and manage. You might be right at identifying the first stage. Businesses can be at very different stages of this process, but this is high level, what it looks like over a long period of time from a business standpoint to actually maximize the value from your business. So then we go to the 4 intangible capitals. So 4 intangible capitals are some of the most important pieces of building value in a business. So about 80% of true value of a business lies in the 4 C's, or the 4 intangible capitals. Now, what I mean by intangible capitals are these are things not necessarily like assets or hard assets like actual property or anything like that. Those can be easily measured. Intangible capitals are capital that adds value to your business that are harder to quantify, and that's why we define them as 4. So human capital is, do you have good people in place? Do you have people that do a great job? That are very reliable? Do you have people that are closer to retirement, or maybe they're starting your career? If I'm purchasing a business and I want to purchase a business that have more reliable people and people that are going to be around longer, that adds value, right? So that will drive value by having those right people in place. Customer capital. Do you have a large customer base? Do you have many different customers, or do you just have one main customer? Maybe it's a smaller customer. One looks a lot better than the other if I'm buying your business, right? I want to see a lot of different customers. I want to see a diversified customer base. So if one of those customers fall through, I'm still getting a steady stream. That's more valuable to me than if I'm just see one main client or customer that maybe you as the owner have the relationship with. Structural capital is, do you have the right systems in place as a business? Do you have the systems in place that if you were to leave as a business owner, everything would run smoothly? Or do you have the type of systems in place that are dependent on you? Do you heavily utilize technology, or do you still use paper? And so those aspects of the business, do you have the right structure in place, are very important to add value as well. Me as the business owner, I want to see a machine that runs itself, the systems in place, the technology in place, everything in place, that it will continue to run with or without you, the business owner. I want to see that. That adds more value. And finally, social capital. Where do you stand as a business, right? Do you have a strong brand? Are you well known in the industry? Do you have a strong standing in the industry? That all looks better to me than a weak brand. You're not a very strong standing in the industry, etc. That all adds value. So these are things that aren't easily quantifiable, but as you can understand, are incredibly important to the buyer, because I want to see all of these things. So it's important to understand these things within your business itself, and make it intentional to improve these. So what I've found is a lot of business owners may or may not be doing this unintentionally, but in the exit planning process, you want to start intentionally improving these things. If you don't have the proper processes in place, start making them. If you don't have the right good people in place, start finding them. This is a very important part on building the value in your business. And frankly, it's one of the harder pieces, because oftentimes there's a lot of improvement opportunity here, but this is where a lot of the untapped value can be oftentimes. Now, there's a difference between readiness versus attractiveness, right? And this is going back to transferability. Is you may be ready for a bit to sell your business, but does somebody want to actually buy it or not? Is it attractive? Same with the business itself. Is the business ready to transfer or not? And maybe it's not. So it's important to look at both of those things. Is you want a business that is very ready to transition. You want to be really ready to transition. And then also you want a business that's very attractive to transition at the same time, and you want to be attracted to a transition as well and excited about that as well. So that's where you try to get that balance of having both of those in place. And these intangible capitals are usually have the biggest impact on that range of value, like I already kind of touched on. So number 3 is the 3 gaps. So you may have noticed I've mentioned this a few times, but these are very important as well. Is the 3 gaps of exit planning are the wealth gap, the profit gap, and the value gap. So why these are so important is the wealth gap is the first one, and that's how much you need your business to, how much do you need to sell your business for to provide the money that you need after you sell your business. So this is putting on my other hat as a certified financial planner is you want a good financial plan to really understand, okay, once I sell my business and go into the next stage of my life and start doing the things after my business and that I'm excited for, I need to know how much money I need to provide, because when I know that, then I know, okay, if I need $1 million or let's say $5 million after I sell my business to live the lifestyle for the rest of my life that I want, well, now I know that, okay, I need to sell my business for at least $5 million, right, to be able to provide that. So that's the wealth gap, is to identify how much do I need from my business sale. And the profit gap is you take a look at the industry leader in your industry versus you and get an idea of, okay, how profitable or not is my business right now? So this gives you an idea of a benchmark of, okay, the profit gap is how much do I need to improve the profitability of my company to make it more valuable? And then the third one is the value gap, which is looking at, okay, how much, looking at, again, the industry leader, how much value they have in your business, how much their business would be worth if somebody went and purchased it versus what mine would be if somebody came and actually purchased. And so that gap you want to start looking at and comparing the industry leader to see, okay, what are they doing? I'm not. What are the improvement opportunities to kind of start closing that value gap of, I want to make sure I get the right value for my company. So these are all really important gaps to cover, because taking all these into account tell you all the information and the target you need to build your business to in terms of value and to actually sell out of as well. So you want to look at, I'm introducing the personal side or the wealth gap first, because that is where it's all driven, right? The statistic is around 70% of deals actually fall through because the business owner gets cold feet. And oftentimes the reason that happens is because they don't know what the next stage is going to look like. They aren't excited about it. So that's why the wealth gap is so important, is because we want to identify what we need as well as what we need that money for, so that the business owner is excited about it and ready to move forward on it, because that's the biggest killer of a deal. There's a lot of fancy formulas that can be done for these gaps I won't go into today, but it's very important to go through each of these ones and recognize that there's importance on each one. And then there's the real number versus tax number is something I want to bring up, because there's a difference between what your business is worth with you and without you. So a real number versus a tax number. A real number is the actual value if you take, and it's calculated by basically taking out all expenses associated with the business owner. For example, if you have like a company car or something like that, or whatever other benefits your business provides, it's important to take those out so that you can, again, see what the value is of the business without you around. And the tax number is different. It's what you want to show up from a tax perspective. That's where an accountant will come in as the team to make sure to show the business as being, if you want to pay the right amount of taxes, not more than necessary or less than you should. So it's important to have an accountant on your team to make sure that tax number is correct as well as the real number is correct, so you have an idea of what value you can actually get. And the holistic, I keep talking about keeping everything in sight, and that's because the holistic plan is so important. All these pieces need to be taken into account, because again, it simplifies a very complicated process. Now, there's two concurrent paths. I like to call this the business owner conundrum, but it's important to keep these both separate, right? You want to keep business as well as personal somewhat separate, because what happens, what I found a lot is that as business owners grow their business, the personal and business tend to merge, especially early on, because they're using all their money, reinvesting all their money into a business, and again, growing the business oftentimes into a very valuable asset. But now when we go to sell, we find that those two items, the personal and business, are meshed together. So what we want to do in exit planning is start separating those two, is starting to make your business work, make you work on your business, not in it. Again, creating a machine that can run with or without you. And then you separating out personally your lifestyle so that so you're not super reliant on your business. So you're not in that situation that when you sell your business, you either don't have enough money, or more importantly, you don't know what you're doing with your life, and you get really depressed and don't want to actually, and you start regretting your business, like the statistic shows on the screen right now. So it's important to start separating those through the exit planning process, so that when you do sell the asset, that your personal side, which is what will be left, is going to be taken care of. So it's important to separate those things out. Oftentimes, I've found a lot of business owners have those two meshed, because frankly, when you're building a business, you should have your business and personal meshed to an extent, but eventually you want to get to the point where you can start separating them out, usually within the growth phase of the business, because now you've gotten past the challenge part. But oftentimes I found most business owners don't do that. They intentionally just keep things meshed. And as if I'm looking to purchase your business, obviously I want to see something that's not as meshed than versus not. And then 90-day sprints. I already touched on this, but it's important to do this and ask the question, do I want to sell or not? And you do this after you've separated these two things out a little more. So the final one is goal. The main goal, and what we're talking about today, is selling the business and getting the most value possible out of the business, so that you can then have the three legs of the stool, the personal, business, and financial, balanced correctly. So when you actually do go to sell, then your personal side, you personally are excited for the next steps. You personally know exactly what's going to happen after a business. The second leg is the business, that the business is going to survive without you, and the owner and the new buyer is going to be happy with the transition, so that all party involved, there won't be any issues, and it will be a smooth transition. And then the third is financial, that the business finances as well as the personal finances are taken care of, so both parties can go off in their separate ways, and the actual transition can happen moving forward. That's why it's so important to have those three pieces balanced, is if one of those get out of whack, the whole thing can be screwed up. And so you can go, by following these methodologies, you can quickly go from successful to significant. That's what we want. We want the most value for you. And when you get to the next stage in life, believe it or not, it can still be fulfilling and purposeful. For those that have built a business, you know that, and oftentimes the big question is, what are you going to be excited for after the business? So it's a very important thing to start asking yourself that in this process, but even frankly before this process, what's your purpose? Because I found a lot of business owners, their purpose is defined through the business, but that shouldn't be the case. It's your purpose should be achieved through the business and with the business, not because of it. And so it's important to really think through that and start defining what you look like and what your purpose and your passions are outside of the business, because that's going to be a big piece to this main goal, which is get as much value as you can out of the business. So we'll go through this quickly, but because this is something I can send outside of this, but it's important to go through this checklist to see if you as the business owner, or if you're actually ready to sell, because you might not be. And that's one of the biggest pieces, is you need to be ready as a business owner to actually sell. And also underneath there is the business ready to sell? both of these things are what we're going to be answering or asking in the exit planning process, because it doesn't matter if we do everything I talked about, maximize the value, everything along those lines. If you guys aren't ready or the business isn't ready to move forward on the sale, nothing's going to happen. So here's a checklist. I won't spend a ton of time on this, but these are some things that you should think about, and it'll give you an idea if you're ready or not, if you can check some of these boxes. Have you started getting educated? The fact that you're on this call right now the answer is yes. You at least want to learn, which is great. So that's the first step, is to start learning and start letting people know that I'm thinking about this. Second thing is the personal financial business goals. Are they aligned? Yes or no? Did you start or have you started communicating with a transition advisory team, like a certified exit planner like myself, which I'm happy to talk with anybody who needs the help about, or like an accountant, an attorney, anything along those lines. The conversation is oftentimes the first step. Do you have a contingency plan about, again, protection in certain circumstances if something were to happen to you? That motivation to actually start protecting is a big step. Have you started an analysis? Have you done an evaluation of your business recently? That's another big step. Have you looked at all the options out there? Have you started out, educating you on what those actually look like? Do you have a written transition plan? Now, this is a big thing. It's one thing to have a transition plan, but have a written transition plan oftentimes mentally solidifies the actual action and reality versus not. Have you designed a post-business life? So this is what I was harping on here a few slides ago. Is very important to know what you're leaving to, so that it's less likely that you won't leave. And then a pre-transition value enhancement, a management program. All these things help solidify the business itself for transition. So these are all things, and I'm happy to send the actual list to you guys, anybody who's interested. But it's very important to ask yourself, are you in the business actually ready before you actually move forward on this stuff? So that's the final question I'm going to ask. Are you ready to begin? And this is mostly obviously to business owners or entrepreneurs, or if you know somebody that has this, ask them the question, are you ready to begin? Because as any business owner knows, an entrepreneur knows, action really is everything. Talk is cheap. And all things in life is this way. Talking about things only gets you so far. Planning about things gets you so far. In the end, you actually have to do the things. And you, as a business owner, didn't get to where you are without it. So it's time to get to where you want to go by taking the first step, which is to be educated and actually reach out to start the formal process. So I'm going to, with that in mind, I'm going to offer as a thank you for attending. Anybody that would like, I'm happy to give you and help send you a link to a complimentary readiness survey. So you can fill it out very easily. I will get a notification. We can talk about it, and you can see what it looks like, and are you as a business owner ready or not, just to kind of get the wheels turning. I'm happy to do that for you. So please let me know if you'd be interested in that. And then if you'd like to learn more, check out our website. We're going to be doing a lot more of these. So if there's a specific subject on this topic that you saw or I went over that you're interested in learning more, or you want me to drill down in, happy to do so. I'm planning on doing a lot more of these. So sign up for our newsletter. Keep an eye on our website. We're going to be putting out a lot of different content around exit planning here, but really trying to get the information out there, because oftentimes I've seen that business owners just don't really know where to start. So we want to start getting that information out there for everyone. But these are some QR codes. I'm going to send out a recording after this. You can pause or you can scan now if you want to get taken to the website with this information. But with that being said, I thank you all for your time. I will pause and sit around for a little bit if anybody has